Okay, so how do we calculate depreciation? Well, first of all, we need to calculate the net cost, which is the overall depreciation for all the useful life. We use original cost subtracted by the salvage value, so you get a net cost. And then we're going to use the net cost divided by the number of years to get the annual depreciation. In this particular case, if you start with a price for the machine for $26,000, and then you estimate the machine is going to be worth $8,000 at the end, the total net cost is 18,000. 26 minus 8, that's 18. All right, so based on that calculation, we say the equipment has a life of 5 years. So and the ending value is 8,000. So we just calculate this 18,000 already. And we are going to use 18,000 either divided by 5 years to get the annual depreciation of 36,000, 3,600, I'm sorry, or we use 18,000 net cost divided by the total number of a month during the 5-year period. If you use 18,000 divided by 60 months, that is 300 per month. And our record keeping requires us to record a depreciation expense of $300 for 1 month. All right, here is how it goes. So we have a equipment being purchased on December the 1st at $26,000. It's an asset, so when it increases, that's on the debit side. And after a month, at the end of December that month, we will have to record a depreciation expense, which is a debit of $300. We calculated $300 already. And that expense is incurred. It's not really a $300 cash we spent. It's just how we record depreciation expense. And here we have cumulative depreciation. That's basically is the total depreciation got accumulated over the past periods. Since it's the first month, the cumulative depreciation is 300, and then it's going to reach to 600 in the next month, 900 in the third month, so on and so forth. And then we can combine equipment with the cumulative depreciation to get the net fixed assets value. As you can see that when depreciation expense is incurred, $300 debit is put here, and for cumulative depreciation, we put a credit. And we see cumulative depreciation as an asset. So, but it's just a negative asset because we are going to use equipment to be subtracted by this cumulative depreciation. So that's a negative assets. And when assets increase, it's supposed to be a debit, but because cumulative depreciation is negative assets, so when that increase, we put it as a credit. All right, and now after we have done this journal entries, and we can put it right here, depreciation expense, debit, and cumulative depreciation resulted from this expense that is incurred on the value of equipment is 300, all right? So that's 300. And right here on the balance sheet, you will see that there's no cash being involved in this whole event. But there is a $26,000 equipment, and then there's a cumulative depreciation for 3 months. Each month is 300, and then the net value of your equipment after 3 months of depreciation is 25,100. Okay, so as you can see that cumulative depreciation is on the assets part, right? It's a part of the assets, so we can call it assets. It's just a negative assets because instead of adding 900, we deduct 900 from the equipment's value. So let's get back to our basic record keeping. How do we record this? Is that the debit or credit? The answer is a credit. So when a negative asset increase, that's a credit. All right. So here are some steps we need to follow for adjusting prepaid assets account. So we have current account balance. We need to know what that equal, and then we need to also figure out what the balance account is supposed to equal. So what the real is and what is the proposed or expected value is, and then we'll adjust the entry from the two steps. And here are several items. We have a prepaid insurance. This is something we talked before, but in this case, the preferred insurance account has a $5,000 debit balance to start the year, all right? And a renewal insurance policy and payment shows a $1,000 of unexpired insurance remains at the year end. So this is step one, 5,000, how much it starts, and this is 1,000, how much it ends. So your insurance is still good for another whatever years for $1,000 value. Well, I should say 3 months, because the difference between 5,000 is and 1,000 is 4,000, and that covers a year. And 1,000 should cover, if 4,000 covers a year, then 1,000 should cover 3 months, right? So this 1,000 is the remaining value for your prepaid insurance. That 1,000 basically means for the next 3 months, you don't need to worry about insurance payment, although there are expenses being recorded on your income statement. Next, prepaid rent. Just like a prepaid insurance, if you have a prepaid rent, that will be an asset, and when rent expenses being recorded month by month, these assets would go down. So if you read this paragraph, on October 1st of the current year, the company paid $12,000 for 1 year rent for facilities, and then the company debit prepaid rent and credit cash for $12,000, and since the whole thing happened on October the 1st, which is a 3 month, actually October, November, December, yes, 3 months before the year end. So we need to figure out what happens during this 3 months. So if the $12,000 is a whole year rent, then $1,000 should be a monthly rent. Is that right? 12,000 divided by 12 months, that's 1,000 per month. So during the 3 months, your prepaid rent has its value reduced. You don't need to worry about 12 months. Now you don't need to worry about for only 9 months. So you are worse off by 3 months of periods. It also shows that you have a less coverage for your future rents. And right here is called supplies. The supplies account has a $1,000 debit balance to start the year. Supplies of $2,000 were purchased during the current year, and a debit to supplies account. So basically, the supply started with 1,000. That's how much you had at the beginning, and you purchase another 2,000, and then that's basically add up to 3,000. And then on December 31st or year end, you only have 500 supplies remaining. So that basically shows you 2,500 supplies were exhausted, were used, were gone. The next, accumulated depreciation. The company has only one fixed asset, which is equipment that it purchased at the start of the year. The cost was $38,000 at the beginning of the year and had a life of 10 years, and expected to be valued at $8,000 at the end of the 10-year life. So what happens here is the beginning value is $38,000, the end value is $8,000, so the difference is net cost. That's $30,000. If you use $30,000 divided by 10 years, that's $3,000 per year. So if you buy the machine at the beginning of the year, then at the end of the year, the $3,000 expense for depreciation would be incurred. So the ending value should be $38,000 minus $3,000 depreciation. So here is the general journals we have. You will see that prepaid insurance is $5,000 debit at the start of the year, and then after a whole year, you only have a 1,000 left. So that's your unadjusted balance. So that basically is what the current account balance equals. All right. And now you want to do an adjustment because it's the end of the year. You need to produce another financial statement. And then based on the remaining value of the adjustment prepaid insurance, that's only 1,000. You will know that in the past, there are $4,000 adjustment credit for prepaid insurance. That also means the prepaid insurance as assets got its value reduced by 4,000. And for the general journal, you will see the insurance expense is 4,000 during the whole year, and the prepaid insurance has its value reduced by $4,000. That's a credit for the assets. All right. And then next, for prepaid rent is a similar story. So the prepaid rent started on October the 1st, which at $12,000, that's how much you have paid. That's how much sitting on your account. But at the end of the year, it's time for us to produce the ending year financial report, and we have to check what's the remaining value for the prepaid rent. Okay, so what it should be equal to. And then you shall find that after 3 months periods, so you only have a 9-month period that you don't need to worry about rent payment. Okay, so from 12 months you reduce to 3 months to 9 months, so that's a $3,000 deduction for the value of a prepaid rent. Okay, so as we study this over and over again, we're going to record on a accrual basis other than cash basis. So as long as the rent expense is incurred, is recognized, then we're going to put it in our report, not just when the cash is paid. So right here, you have an expense with a debit of 3,000, and for your prepaid rent as assets, it increased by 3,000. So the credit is 3,000 here. All right, and next, so the company has a supplies, and I basically mentioned this already. You started with 1,000, and you also add another 2,000 during the year, and then you only have 500 at the end. So basically, the difference is 2,500. So that basically shows you from the difference between the beginning balance and ending balance, you know how much supplies were being spent. All right, so your supplies expense is 2,500. Since it's expense, you're gonna put it as a debit, and for supplies, that's an asset. Because it's going down, you should have a credit. Next, accumulated depreciation. So first of all, if you look at accumulated depreciation at the beginning of the year, it was 0 because the machine was brand new. There were no depreciation incurred. But after the whole year, then you only have some value left, and the accumulated depreciation is $3,000. That's the depreciation for this year and also for each year in the future. And how do you get it 3,000? Again, you're gonna use the 38,000 minus 8,000 divided by 10. That's your annual depreciation. And then you should record the difference. So you will see an expense called a depreciation has incurred. Not necessarily you spend cash on it. It's just when there's an expense, you have to put it in your report. And then you have accumulated depreciation. As I mentioned this before, accumulated depreciation is a negative assets. So when a negative assets increase, that's not a debit, that should be a credit.